Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is Wednesday, November 8th, and today we have Luke Gromen and Ira Harris. Luke has become one of the most respected names in the global research sector. He has 20 years experience in the industry, has earned a reputation as a client-focused analyst with unparalleled ability to make broad connections between increasingly siloed industry news and drawing conclusions that help investors understand the bigger picture. He offers unique insight research derived from a wide variety of sources that provide a clearer picture of global macro, thematic, and sector trends. He founded FFTT LLC in early 2014. FFTT caters to institutions and sophisticated individuals by aggregating a wide variety of macro, thematic, and sector trends in an unconventional manner to identify investable, developing economic bottlenecks for his clients. And Ira's independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and also a stint most recently. Welcome, gentlemen.
Thanks for having me here.
Great. I thought we'd begin with your macro view, Luke, in terms of like what your macro view is on the global economy and the financial markets.
I think there's probably two big gears in my macro view that are increasingly, or that began about a decade ago and have been accelerating ever since. The first is global central banks stopped growing their holdings of Treasury bonds in 2014 on a net basis. The supplies of Treasury bonds didn't stop growing, obviously, given what debt and deficits have done for a variety of different reasons. And I think a defining picture or defining dynamic of macro since global central banks stopped growing their holdings of Treasuries for the first time in 50 plus years has been the actions and reactions that have followed by various players since. So when global central banks stop buying treasuries and U.S. Treasury issuance continues increasing, if not accelerating, it drives a crowding out of global dollar markets. And we've seen a variety of steps taken by policymakers to regulate U.S. banks, U.S. money market funds, U.S. pensions into buying more and more treasuries. And ultimately, what this does is send the dollar higher by crowding out global dollar markets, send dollar rates higher, all else equal, which gives you this virtuous or vicious cycle, depending on what side of it you're on, until something breaks. And increasingly, what's been breaking has been the Treasury market or U.S. dollar funding markets themselves. And then the Fed has to step in and they call it not QE, or they call it QE, or they call it BTFP, or they call it something, but they or Treasury supply dollar liquidity. The dollar comes back down, wash, rinse, repeat. We've been seeing this cycle accelerate faster and faster since 2014. And the other dynamic that sort of accelerates this as well is what I've talked about as peak cheap oil, which is, it's not that we're running out of oil, but the oil we are finding and producing is getting much more expensive. And to the extent oil rises in all of this, it can accelerate that Treasury dollar cycle, because anytime you get a United States creditor nation that is also an oil importer, like Japan, if oil gets high enough that it pushes them into a current account deficit position, they need to finance that deficit. They finance that deficit by selling treasuries, which is just accelerates, turbocharges the virtuous or vicious cycle of dollar treasury rates that I just described before. So that is kind of the two big macro gears I've been focused on for some time.
Mm-hmm. Yeah, very interesting on that dynamic. Any thoughts, Ira?
No, it's interesting, and I because the way the media portrays what Luke has to say is, well, yields higher, but it's not. It's just a step in the process, right? We know that with the right before this, we did a podcast with Mark Chandler, and I followed Mark. I've been around a long time, Luke, doing this. I'm a global macro. I started in the currency markets back in the 70s because I studied multinational corporations as a graduate student in Wisconsin in political economy, really political science with emphasis on political economy. And I've looked at this with the flows of dollars, and and for the short term, if I understand you, the debt structure of the global economy puts a bid to the dollar, but it's not a structure that can be sustained. And we saw that too, especially if we go back to the Volcker, 70 when Volcker was busy raising rates, and the large U.S. money center banks, Citibank, Chase, JP Morgan, when they were busy recycling all those petrodollars to who? To those who needed the funding most, which are, of course, we don't use this phrase anymore, third world countries, because their import of energy soared, and they couldn't generate enough revenue to cover it. So and as U.S. rates went higher, they were forced into that, as you said, the vicious cycle. Are we there yet? I don't know. I don't know. We still get the dollar bid at times, but I think it's one of those, the dollar goes bid for all the wrong reasons, but that's in the short term. I'm a trader, so I certainly have to react to that and pay attention to it. But I think your point is really interesting because there is a huge overhang of dollar-denominated debt that has to be financed. It has to be financed.
That's right. And there is, I thought your point about there's sort of the media and a lot of strategists look at the dollar going up with this, and they kind of, thump their chest and say, this is great for America, and this is because we're winning. And no, it's not actually. And there's been a resurgence. Actually, there was a New York Fed white paper last December talking about the resurgence of the Soros imperial dollar cycle from the early 80s. And it kind of runs through it, and people saying, hey, this is what we're doing. Powell's going to be like Volcker. And the problem with that is that the Fed, if they are doing this, and the market action has certainly supported whether they're intending to do it or not, it's how it's happening in terms of the dollar reaction and the rates reaction. The problem is that they are operating from a significant misapprehension, because we are at a 180-degree different starting point. So in 1980, we'll call it, when Volcker really got aggressive, technically, I guess it was late 79, whatever, state from 1980, when he got very aggressive, the U.S.'s net international investment position, so the amount of foreigners, the amount of dollar assets that foreigners own of ours against what we own of theirs net. So the U.S.'s net international investment position in 1980 was around 10 or 12% of GDP positive for the U.S. In other words, we owned about 12% of U.S. GDP more, 12% more than they owned of ours. I guess it was closer to 8 to 10. So 8 to 10% more. So as you raise the rates, you get that flow of capital back here to support the dollar. That's sort of the healthy flow. In contrast, what has happened, or the net international investment position now, is negative 65% of GDP. In other words, foreigners own about $18 trillion more in our assets than we own of theirs. $7.5 trillion of that are Treasury bonds. And so the flows, there wants to be this ascribing that, hey, we're just going to run the Soros imperial dollar cycle like Volcker again. it's literally the flows are going the complete opposite direction. Then the flows were coming here because the dollar was strengthening, rates were rising, and the capital on a net basis, our capital was there and came back home. Now their capital is here and needs to leave to finance this massive dollar debt that you were referring to. They've got about 13 or 15 trillion in offshore dollar debt. So there is this, it's a very self-destructive. I mean, when the dollar's going up, what we're watching actually is not the US winning. We're watching the US dollar-centric system of the last 50 years unwind violently. And so there is, back then they couldn't print the dollars. They still can't print the dollars. However, back then they did not have a dollar asset piggy bank to the tune of 65% of US GDP. Now they do, and they can, and they will sell. And as a trader, I'm sure you don't always sell what you want to, you sell what you can. You need dollars, what do you sell? You sell treasuries. And so we've seen this vicious cycle drive dollar and rates higher. The other two things really quickly, they're diametrically opposite, is that US debt to GDP in 1980 was about 25-30%. There was no rate that Volcker could conceivably take rates to that would threaten the solvency of the United States, where the US interest expense would go above tax receipts, which is when hyperinflation, kaboom, it's over. When the central bank has to print the difference, print the interest. We're there now. We now have debt to GDP of 120, 130%. There is a rate, and it isn't that far from here, where if this vicious cycle takes rates that high, it's going to credibly threaten the U.S. Insolvency ratio. And then the final part is just the deficit under Volcker when he started was, I want to say 2% of GDP. I think at its absolute worst, it was 4 to 5% of GDP. The Fed started this tightening cycle at 6, and it's now 8 on a trailing 12-month basis. So Treasury is competing for that capital at the same time foreigners are selling. And so there is a view that they can run this Soros imperial dollar cycle, but it's literally in the key metrics, 180-degree different flows, debt, deficit. And what that means as a trader, as for the markets, is there isn't going to be a linear breakdown. There's not going to be a linear rise in rates. It is going to get very convex very fast if the dollar keeps rising. And so it gets to this very volatile and binary outcome. They got to get the dollar down big, but inflation's still too high.
Alexandra Harris.
And so how does this interplay dynamic between oil, the US dollar, and treasuries end? Or is it like a shooting star? When do we get the peak in the US dollar? Any ideas? Or
gun to my head, I don't know, but gun to my head, I think we're probably, I bet you 107, that when we ticked 107, I think we're going to look back and say that was probably. Now, the challenge in all this is, like, if we have a crash or if we have some sort of crisis, the dollar's going to go through that like a hot knife through butter, and people say, oh, well, you're wrong. Well, the Fed will come in and beat that right back down. They'll have to, because it will be threatening the Treasury market's liquidity for the reasons I just said. But assuming no sort of one-off crisis, that the machinery just kind of keeps grinding away, I think we're probably there. And the reason I think we're there is the Treasury volatility indices. You can look back over the last, what I've been writing for clients is it's all for this machinery, this vortex, this vicious cycle is all fun and games until the Treasury market loses an eye. Your parents used to always say, hey, it's all fun and games till somebody loses an eye. So anytime the Treasury volatility index, as indicated by the MOVE volatility index, gets to about 130 on the upside, the Fed has come in, or the Treasury has come in with significant dollar liquidity to get the dollar down to basically defend the Treasury market. And we hit 141 on October 3rd. Ever since then, it's been the Fed jawboning the dollar down. It's been the Fed backing off. So I think we're in a topping pattern in the dollar because, again, they were able to get the volatility in the Treasury market down. But this is a structural issue. The dollar can't just stay here. It needs to get down a lot. And there's ways they can do that. perfect example is what Treasury announced last week, which is where they came out and said, hey, instead of terming out the debt next quarter, we're going to significantly reduce long-term or longer-term issuance and bring it forward to the front end, which will allow it to be funded out of the reverse repo, which is effectively a liquidity injection. So you can see them, they are desperately trying to, as I've called it, ride two horses with one ass. They desperately want to keep fighting inflation, and they desperately want to get the dollar down to maintain the Treasury market functioning, to stop that volatility. In the end, they can only do one. And my ongoing view is they will choose to preserve Treasury market volatility and sacrifice the dollar, not the other way around.
Yeah, I think. Also, yeah, what are your thoughts, Ira?
Okay, a couple things. So now for Halloween, I know you went as Harley Bassman.
Okay.
So I know we can laugh and appreciate that because of the move index. I go back and forth with Harley. So I say that as a great compliment, by the way. Number two, your point about Volcker. And we go back to, and this is when I was actually trading. So I started trading in 1977, but I was studying all foreign currencies, old multinational back in 75, 76 through the beginning of 77. And these are all so important because what did we hear? For last year, all we heard was after they missed the whole concept of transitory inflation, when those brilliant forecasters kept QE going while they were talking about it all the way to March of 22, which was preposterous. But they were so afraid of market reactions, they're just terrified of them. The Fed, it's interesting, and I'm sure we'll get into this a little bit. But as I said back then, when they started, Powell needs to find his inner Volcker. In this, as you talk about, 120%, 110, 120% deficit to GDP ratio, debt to GDP ratio, I'm sorry, not deficit, but debt to GDP. Volcker couldn't find his inner Volcker because had he raised rates, and I lived through that period, to those levels, the world would have been brought to a global depression, especially because of, as we opened up talking about, the situation of the third world countries who were heavily indebted as they were just trying to sustain themselves in the face of higher energy prices coming out of 76 and 77. Now, back then, I come from a very Marxist background with a lot of Austrian, because my mind was open, and there are views on debt from Fisher and Mises, and of course, von Hayek. You had to pay attention, even though I'm at the University of Wisconsin in the mid 70s. So you know where I'm at, but they were good thinkers, and they taught you really how to think and how to look at these things. So when you saw those debt issues, and who had the idea of the debt were the Marxists. They understood, the Marxists and the Austrians understood how this debt was going to sink the underdeveloped world because of what they'd have to do. And when I went looking for a bank job in 77 before I went to the exchange and doing foreign currency, and they said, well, why should we hire you? You don't have an MBA. You have a master's. But they said, well, how are you going to help us? I go, because all your third world debt is going to implode. And they go, oh, it's the best lending that we're doing. I said, no, you're not reading the Marxists. You're not reading the Marxists who really understand this stuff. And, you're crazy. You're crazy. So as I always said, they didn't understand that. And once Volcker went that route, but had we been at these debt levels, we wouldn't. So we don't know. And I think that's where I loved reading you. We don't know where this break point is. And the market and the mainstream media, when they pick you up, all they talk about, well, it's good for the dollar, dollars. And I see, fringe people who pick you up. I hate going on Twitter, but when I read some, the dollar's gone. Well, I don't know that Luke is saying that at all. And, and tongue in cheek, I call you Cool Hand Luke, because I think you would agree. I don't know whether you've seen the movie, but it's a great line. Sometimes nothing is a real good hand. And I think, so when I go, Luke Gromen, Lucas War Hero, because he understands the United States is playing a zero hand to its best until they can't anymore, until the world says we've had enough. And so I love listening to you. And when I was just on with Chandler, but I was also on last week with who was it? Who were on Joseph Wing and Mark Faber. So it's a pretty good lineup that I've been in, and I love that we're completing this with you. But I think you feel the same way. The Japanese yen is the most undervalued currency in the world by a lot of metrics. I don't know if you openly say that, but when you look around the world, yeah, it's pretty. And I know they have their debt issues, but debt to GDP in Japan at 247 is different than the U.S. because all of that, or it used to be 97% of Japanese debt was owned by domestic. And when they had deflation, they actually, domestic debt holders did really well. We've never had a deflation. Bernanke was scared of it and made a lot of policy errors in his fear. But, he had Steve Leisman, of course, always argue the counterfactual for him. Well, if we didn't do this, yeah, I know, but look where we're at. So I love, that you go there. So.
Yeah, I think Japan's, you raise a great point about Japan is that that's another situation where people say, well, the U.S. is just going to be Japan. And Japan's situation is, the setup is 180 degrees different than the United States. They have a positive net international investment position of almost 60% of GDP. They have a piggy bank. They can bring back money to finance deficits for years and years and years. And they finance internally. And so deflation is okay. We finance externally, or, most historically we did. And so you can't have deflation, because not with these debt levels, because you go into a debt spiral, and then you can never get out of it. And at any rate, there's a political economy question, right? Because if you go into deflation with foreign holders of your assets, they start being able to do what we did to the emerging markets all those years, which is foreclose on valuable assets, and that becomes a political question as much as an economic question. So I agree. I think one of the things I've written about, it's been a while, but has been historically, when the dollar had a monopoly on oil and commodity pricing, that was a key linchpin, a key to keeping the dollar system as structured. Once oil began being priced outside of the dollar, once commodities began being priced outside of the dollar, and yuan to a lesser extent in the euro, that sets off a chain reaction where currencies begin trading more on balance of payments fundamentals over time. And if you lay out sort of the classic, the prevailing view of currencies, which is the dollar is the cleanest dirty shirt, that is true as long as the dollar's monopoly of the pricing of commodities and oil remains intact. The second you start shifting volumes of the real world commodities to other currencies, the world starts trading on balance of payments fundamentals. The debt and then the currencies. The debt will go first, and then the currencies will follow, the sovereign debt. And the U.S. is the dirtiest dirty shirt. Actually, the UK is probably the dirtiest dirty shirt, the pound. But the dollar's right on its heels, because we're the two biggest current account deficit nations out there. Whereas the yuan, the yen would, in theory, be pretty undervalued on that. The euro sort of within the SDR basket, sort of down the middle. They're about neutral. But yeah, it's a very interesting point on Japan. I tend to agree.
Well, and you raise that point. So, and I say this to people, we're probably in the first or second inning of any type of global financial breakage. And they say, well, why do you say that? I said, because exactly what your point is. If we go back to 09, 10, 11, 12, 13, 14, when there were cracks in the global financial structure, we had what was called the risk on, risk off trade, right? Which was totally predicated on the yen. Because the Japanese, because of their massive amount of foreign investment, which I agree with you, people don't factor that in. But the Japanese could easily cover, I would say much easier than the United States, could cover their debt because of their huge amount of foreign investment. So we saw risk on, risk off. It was so, my Bernard Connolly, one of the great minds, wrote about it all the time. Risk on, risk off. And all you did was have to watch what the Japanese were doing. They're not doing it right now. And it's really kind of interesting into this realm that even when we get earthquakes, so to speak, in like between the Ukraine war and now the war in Gaza, and we've had many other things. We had the banking crisis in not that long ago, March of 2023, which I don't think we're done with. I think Chris Whalen has covered that as great as anybody. I don't think we're done with, but we haven't seen the Japanese run with money home. And that makes me scratch my head. Why? They have a history of doing this. And I'm wondering, and I've just discussed this with others, but I wonder whether this is part of the United States in order to reshore. And I'll tell you, Louis Gavay really put this forth out, Richard, it must be a year and a half, 2 years ago, that they would let the yen weaken in an effort to move business away from Europe, which I thought was an interesting thing, and maybe out of China. Because if the Japanese yen is held very weak, you can reshore some of the industry that's been howled out during the years when the yen was 80, 85, 75, 90 to the dollar. When and they invested all that, they were very smart. They're not always smart. I'd say the Japanese are pretty weak traders over the course of my existence in this world. But I think they were very good with this, and that point is phenomenally well taken. And it bears greater watching. And as I say to others, now the United States is pushing them to spend more on defense. Well, you give me a competitive yen and allowing Japanese industries who are very capable to move into the competitiveness of the global defense industry, you're going to open up a Pandora's box that's going to come out and bite you in a very big way.
Well, especially I've heard credible rumblings that the U.S. might be allowing Japan to buy some oil in yen from Russia and elsewhere.
Wow.
Which right? Because when you think about what I was just talking about is if the U.S. sees it as a good strategic idea to let the yen weaken so that they can compete with China, basically a weaker yen to try to deindustrialize China, strategically that makes sense. The where that gets Japan is and then back to the U.S. is the import costs for energy to do that go up if the yen is weakened against the dollar and Japan needs to buy energy in dollars. But if Japan can buy energy in yen, and then that's actually going to continue to weaken the yen because you're going to be sending more supplies of yen out to buy energy. And there's not a huge bid for yen debt like there is for dollar debt that sort of sterilizes those newly created yen flows from energy, petro yen, if you will. That prevents the Japanese from having to sell as many treasuries as the yen weakens to buy energy effectively. But like you said, ultimately there's some, down the road, what does that do? And I don't know.
No, but I'm sorry, Richard, we're monopolizing the talk, but we went down this road but let me add one thing that just came out while we were talking. This is going to give me a big chuckle. I don't know how Luke.
Okay.
The United States Treasury just removed the Swiss National Bank from being a currency manipulator. Now, that's all the Swiss do, and they openly stated in their monetary. So I read this piece. It just came out, 3 paragraphs. I go, are you kidding? That's all the Swiss National Bank does is manipulate. The numbers came out yesterday. I knew we would get to this, but the S&P is actually, excuse me, 1 second. I have the numbers right here. So their foreign reserves have dropped over the last year. In October of 2022, their official reserve assets, excluding gold, was $831 billion. Now, that's stocks, that's everything valued. But they created a lot of Swiss, sold those Swiss, and bought a lot of global equities. Pretty good alchemy. Well, they're down to, as of yesterday, $670 billion. So they've taken a lot off the table, and that's QT by any other name. So that means that to do that, they must be selling global equities. All we do is see the balance sheet. We don't see any type of financial statement. But I find that very interesting. And then all of a sudden, the U.S. Treasury. So I have, if I had any respect for them left remaining yesterday, it's gone now, because the Swiss are just, that's all they do is manipulate the currency to keep it, competitive. And yet they haven't really done that good a job of it, because, I look at the Swiss yen, and that's at levels that are unbelievable, even as the interest rate differential on 10-year Japanese to Swiss debt has dropped down to what is about 25 basis. I got those numbers. I always keep handy. So 104, what's the Japanese? They're 20 basis points differential. So, and yet the Swiss yen has exploded. The Swiss gaining. So, and the Swiss got a bid today right after the Treasury came out and announced that they're no longer on the list of currency manipulators. I just wanted to throw that out there.
And any ideas on other implications, Luke, in terms of the interplay dynamic, like how it evolves, implications for financial markets?
In terms of
like equities, currencies, commodities type of thing, in terms of trends coming out of the interplay dynamic between oil, the US dollar, and treasuries?
Yeah, ultimately, that's why it leads to a very binary outcome. Is as long as this machinery is spinning, it's great for the dollar. It drives rates higher. It's actually okay for gold, because the higher rates go on this debt pile for the U.S., the better it actually is for gold, because it starts to introduce insolvency risk and some of these, interest expense as a percentage of tax receipts, et cetera. You start to go through thresholds where it's actually good for gold as well. And it's decent for oil until, rates of the dollar get too high, is where you get a significant economic slowdown. And it's sort of been this switch, as I've been in. The Fed thinks they've been operating a dial, but it's not really a dial. Once the dollar gets too high, it's a switch. It's U.S. and global economy on, U.S. global economy off. And that's why I say it's so binary. Is as long as the dollar is too high, you own dollars, you own, it's not good for treasuries. It's good for dollars, and it's all right for gold, and it's okay for oil. And then once that the dollar hits levels, or rates hit levels where there is dysfunction in treasury markets, then you flip the switch, and it's bad for dollar, and it's good for gold and commodities and stocks and Bitcoin, and it's good for everything. Every ticket's a winner except the dollar, basically. It's even good for treasuries for a bit, because it basically lowers the FX hedged treasury yield, or makes the FX hedged treasury yield more attractive. Excuse me, it actually raises the FX hedged treasury yield to the foreigners. But the challenge in all that is that they've been running this switch back and forth since 2014, when global central banks stopped growing treasury holdings. Every iteration comes faster. It gets quicker and quicker. And with each time they do it, the challenge is that the underlying rates of inflation and pressures get greater and greater. And so you're getting to a point now, I don't know if it's the next month, next 6 months, but I don't think it's the next 5 years. I don't even think it's the next 2 years, where the Fed is rapidly coming to a point where if they don't hike, they lose the long end, because the dollar weakens, inflation picks up, and people don't want to own the long end. If they do hike to fight inflation, they lose the long end, because the dollar goes up and foreigners own $7.5 trillion, and they need to sell those $7.5 trillion in treasuries, and U.S. tax receipts are falling because the dollar's rising and rates are rising and the economy's slowing, and they lose. So you're getting into this cornering where ultimately the only outcome is a significant compressed devaluation of the dollar, which can be done a number of different ways. It can be basically snap overnight. It can be some sort of Plaza Accord type agreement, which is probably hard to come by these days, given the state of the world. It can be done with QE. It can be done with running down TGA. There's some things they can do, but it's very, very tricky given the debt loads, because they didn't run down the debt ahead of time. That was in I think when the history books are written about this period, that may end up being the biggest mistake, which was, if you're going to let the debt get to where it got to post-COVID, you got to take your medicine and you do what we did after World War II, which is 110% debt to GDP in 45. You cap yields, you let the inflation run hot, you had capital controls, you do what you got to do, you get debt to GDP back down to 50, 55%. Then you sign the Fed Treasury Accord in 51, re-separating Fed and Treasury. Then you can operate independent monetary policy. But trying to operate independent monetary policy with debt to GDP at 120%, I think is going to be the big mistake, because now it's forced you into this spot, again, in the next 6 to 12 to, I think, 24 months, where if the Fed tightens, they lose the long end, and if they loosen, they lose the long end. And that's the point where you got to devalue the dollar in a snap manner. And so that's how I shake out on it. And I have most of my personal investments unlevered, basically playing for that moment, right? I'm heavily into things like gold and Bitcoin and industrial and commodity related equities, because I don't trade much. I spend most of my time writing and thinking, and I can see these factors, this confluence of these factors, and I don't need to get the timing exactly right because I'm unlevered. So I'm just going to wait, and it's going to be, I'm going to have a magnificent year at some point in the not too distant future, and then we'll reevaluate at that point.
Oh, sure, okay. And Ira, what do you think of?
Well, but you hear the brilliance of Luke, and that's because he says he's unlevered, so he's an investor, not a trader.
Yes.
And people will, especially because my blog, when I was really active writing it, was really geared. You could make investments out of there, and there were a lot of, I think, good ideas, but it was geared for traders. So if you're, by trader definition, is a lot of leverage, and leverage can be a great thing, and it can be a not so great thing, depending upon, it's like owning 10 houses in 2007 and owning 10 houses in 2008. So you were enjoying a cocktail in 2007, and you were enjoying hiring moving companies and getting rid of a lot of assets in 2008. So his point is really beautifully taken, and it's really what it's about. And it really, even at my age, in 2020, we saw that. Exactly what Luke is talking about, because COVID set in, and there were certain things going on. So I said, you know what? There's so much velocity and volatility in the world. I'm going to do more unlevered. So I was busy. We did podcasts with Mark Faber and Louis Gabay. We were talking about it. So because the yuan didn't go down, everybody thought the Chinese were going to depreciate the yuan from 2020 to 2021. But the yuan didn't go that way. The yuan actually went down to 6.2, 6.15. And what did we see happening? That all the commodities, remember, oil went to negative numbers. My good friend Mike Lees, who's an oil guy down in Kansas, said, there's no problem with the oil market. It's because of you guys, meaning traders. He pointed the finger, right? It's you. It has nothing to do with you. But more importantly, because the yuan didn't go down. He told you that the Chinese and I'm a big fan of Mike Pettis. I think, and we've done some podcasts with him. He'd be a really good fit. So maybe Richard. So Michael Pettis, Dr. Pettis, I've done a few, and I have great respect for him for years. I've read his work. Most reliable coming out of China. Not that he's always right, but we had talked about it. If China was going to move to a middle class, they needed the yuan to stay a little strong, and they were busy stockpiling and hoarding all types of commodities, right? We had copper that went down to $2+ and all of a sudden you go, and they started, so owning mining companies and agricultural companies throughout 2020 all the way through even to now were great investments for companies that are usually staid and pretty, the only time they get in trouble, of course, is when they have too much money and they throw it around like the telecoms used to. But those are really good plays. So yes, your day is coming. You don't have to time it. If you're not trading, you don't have to time it. If you're trading and you're employing a lot of leverage, your timing has to be much more critical. But I applaud you because I think that is absolutely, and you're looking at the debt markets. And I don't know how the United States gets out of here. Why would I extend my duration? I've told people for the last 2 years, just keep lateraling your T-bills. If you want to go out to the 2-year, I wouldn't even do that. Stay within, you'll have no capital risk. You're generating something. The banks weren't paying anything at that time, and T-bills were starting to move. And those are all people who've done pretty good here. And they go, is it time to move? I go, not yet. I don't see it yet until I get some clarity. Because again, what is duration? Duration is based on policy credibility. And not just monetary, but fiscal. And right now, monetary policy may have some credibility. I would probably say yes, because we do have using the overnight rates, we do have a positive yield on money at this point. How much I can't tell you because we're still looking through the data. But why would I extend my duration when I don't know where this is going to go? Do they flood the money? And don't forget, it wasn't that long. It was 2 years ago that Powell presented us in Jackson Hole. God, the media is so lazy. When he had his flexible adjustable inflation targeting, right? Where we're going to let it run hotter for longer because we've had 60 months of sub 2% inflation. So if we use stochastics and smooth this out, we can let inflation run hotter, which got him into trouble. But nobody comes back and remembers that. So how are they going to exit this? I have no idea. But I think your view is right on target.
Yeah.
Can't time it.
Just coming to a close on our discussion today, but great insight. And your final thoughts, Luke, and also how can our listeners learn more about your work?
In terms of any final thoughts, I'm just watching Treasury issuance and what they decide to do with the duration of that issuance closely, in terms of trying to term it out versus not. I mean, it's like Ira just said, the fiscal side is a critical driver in a way that it has not been in the U.S. in a long time. And depending on what they do and how they do it, it has very important implications. So I'd just encourage people to pay close attention to that, particularly if you have more of a trading viewpoint. And in terms of how people can learn more about me and what I do, website is fftt-llc.com. Some information about our different research product offerings, both institutional and mass market. And I've got a pretty active Twitter feed at Luke Gromen, LUKEGROMEN, all one word.
Awesome. Thanks. And Ira?
Well, it's the only Twitter feed I will bother to go look at. Because I can't, because I don't have to comment. Luke and I have traded some private comments, but I don't have to comment. I like to see what people respond to. And I think he's getting rid of some of the garbage that tries to tack on to people, but it's pretty good. His work is really worth a read wherever you can find it, because it'll make you think. And that's probably the most important work that we do, is if it makes you think and question what the common narrative is, if I can quote Ben Hunt. So, and you can find me here. I love doing these. I think these podcasts provide a lot of wisdom, not just mine, but of course, Richard, your questions and the guests you put together, we can really ferret out. Like, I think we did a lot of work today. In the mainstream media tries to cover Luke, but I don't think they ever do it justice. So to have him sit and discuss this in this type of scenario is really worthwhile. So, I just come to FRA, which is aptly named Financial Repression Authority, because here we go again, And again, it's the academic outcome to this. You go back to Rogoff and Reinhardt in 2011, and when first of all, Carmen Reinhardt worked on financial repression going back to her study of 46 to 51 is unbelievable. But Rogoff, in his book that a lot of people like to talk about, but nobody ever read, This Time is Different, Rogoff calls for 4 to 6% inflation over a few years in order to get the debt under control. And he and Reinhardt had 95% debt to GDP ratio as a huge threshold. Well, the scary thing, and Luke has written about this many, many times, we're growing the deficit with 4.9% GDP, right? Whatever numbers you want to come. So we have positive GDP growth, and yet we're still growing the deficit by fairly big numbers. So it's where I break with Hunt and Rosenberg, because if the economy goes into recession, why should I extend my duration? Because all the safety nets, and I'm not arguing about it. Von Hayek was a big fan of safety nets, and Schumpeter. I mean, the Austrian School, and that's what really captivated me about the Austrian School outside of their work on debt. They were in favor of safety nets. You need safety nets, but it's going to mean another explosion in deficit spending. And we already have and if interest rates don't come down, forcibly or not, we already know. And Luke, I talked about this with a good friend of mine, Kevin McCarthy, not the Kevin McCarthy in Congress, but from my grad school days, who were still very close. And we talked about that 2 years ago, that the danger, and I talked about it, Richard, with you, the danger would be when the cost of financing the debt was greater than the defense budget. Because now you open up a Pandora box of political discussions on all types of discretionary spending. This is when, and we're here. We got here faster. I don't care about the CBO. I try to pay. They've been wrong for so long. Their forecasting ability, I'm sorry to demean them, is about as good as the Fed's dot plots. But we're here, and I think you got to pay attention to Luke Gromen, because he's looking at it in ways that are very, very important.
Yeah, absolutely. Great, insightful discussion. Thank you so much, Luke and Ira. Thank you.
Thanks, Luke.
Thank you. Thank you very much.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.